Well, hello, Providence Financial friends and family. Anthony Sicaro here. Periodically, I like to give you an update whenever I have something or a couple things that I want to just bring you up to speed on or maybe remind you of. And so this video is going to be a combination of three different topics. The first topic, just really briefly, I want to announce a referral event that we're going to be doing, which we're super excited about. Secondly, I want to give you a quick market update, kind of what to expect here at this point and then going forward. And then third, I want to remind you of something that we've talked about before, but how does all this impact your investments, the investments that you have with us here at Providence Financial? So number one, just a quick minute on a referral event that we're going to be doing. If you attended our client appreciation event, that one of the things that I vowed to do this year is to thank you for referrals, because that's something that we had been weak at in the years past. So we created the Providence Premier Club. And for those of you that are a part of the club and that had a chance to come to the Perch restaurant in Los Angeles, we had a blast. It was fun. We took a shuttle from our office to Perch. It was 25 of us. We had a magician just for us. I don't know how he did the tricks he did. We had an absolute blast. Quite frankly, it was a lot funner than I even expected. The bus ride down was a hoot. We had some people on. It was fun. So now to become a member of the Providence Premier Club, all you have to do is send someone our direction who you care enough about. Do you want us to help like you were helped by us, like we helped you? And in order to do that, we're actually going to add a second event. So here's how this works. We're going to put an event into place, probably at the end of June, beginning of July, somewhere there, where your ticket in is to bring someone with you. And we've got several events on the table. We've talked about doing another private restaurant, dinner, magician, comedian, something like that, where we meet again, have fun. We've talked about taking a chartered yacht out to sea from Marina Del Rey for 3 hours, having dinner at sea. We've talked about renting a suite at Dodger Stadium and having people show up there. We're only talking like 25 or 30 people, where essentially your ticket, you can bring your spouse, you can bring a guest or a guest couple, and your ticket in is to bring someone who you think that we might be able to help. And when you do that, you'll automatically become part of the Providence Premier Club. So what a win-win for everybody. So quick announcement, we don't have the date yet, the time. I will be putting it out later. I'm just kind of wetting your whistle at the moment. That's number one. Just look out for that referral event. Super exciting. Number two, want to give you a quick market update. And then number three, I want to kind of set some expectations for your portfolio and remind you of something that we've talked about before, but oftentimes gets forgotten. So 2 and 3 are probably going to go hand in hand. Let me give you a quick market update as to where we are right now. The one word that has been thrown out more than I've heard in many, many years is that word stagflation. Well, what is that? Stagflation is when let me back up. Stagflation is when inflation stays high or grows while the economy is stagnant, while the economy does not grow or just grows at a very low level. That is stagflation. Stagnant economy with inflation, stagflation. Let's talk a little bit about inflation. The Federal Reserve's job is to keep inflation under control. And depending on the measure you use, there's different measures. Depending on the measure you use, inflation is ranging between the high 2% range and the low 3% range. Call it just kind of 3%. That's about the range. Well, the Federal Reserve wants to see inflation closer to 2% level. Now, the reality is they're not going to wait for it to get to 2% to call it a victory, because they would have waited too long. But they want to see inflation coming down. And inflation over the last year and a half has come down dramatically, but also for the last 6 months, 9 months, I believe, has held at this level. It's been sticky. Why has it been sticky? Well, the reason that inflation has been sticky is because of wage inflation. When companies like grocery stores deal in commodities, they can adjust their prices up and down to adjust for the price of commodities. Commodities go up and down, and so the price of groceries go up and down. So as the price of commodities comes down, they can lower the price of their goods that they offer, the groceries, and then you pay less. So inflation's come down. But wage inflation is a little bit different. The labor market is more normal now than it was a couple of years ago. A couple of years ago, there were 2 jobs available for every worker. And that was an anomaly. I was interviewed recently on a TV interview, and the reporter framed it as the fact that right now there's only one job available for every worker, and that this is the anomaly. And I had to push back and go, no, this isn't the anomaly. A 1-to-1 ratio, one job for every worker, is more normal. A couple of years ago, when there were two jobs available for every worker, that was the anomaly. And all of it was a result of COVID. All of it was a result of people retiring early, and some of the COVID layoffs that happened and so on. But when there's two jobs available for every worker, that's what we refer to as a tight labor market. When you have a tight labor market, it means that the employees are in control. If they didn't like their job, they could go find another job very easily, just like that, and probably get a raise in the process. And as an employer, what I had to do, and what a lot of employers had to do, is they had to actually give pretty sizable raises to the people just to keep them. It's very expensive to replace employees. If you have good people and you want to keep them, it's so much cheaper, so much more beneficial for the employer to give raises to keep the good people. So we gave a lot of raises. And that's wage inflation. We had to give more raises than maybe normally we would have given. So now that takes us to where we are now. The labor market is normalized. And the reason inflation is sticky is because those wage increases have to be passed on to you, to the consumer. And yet you can't take them away. Again, if we're a grocery store, you can lower prices as the price of commodities goes down. But once I give a wage increase, once I give someone a raise, that is never coming back. Imagine how that conversation would go if I had to tell an employee, we gave you a raise because labor market was tight, but now labor market's loosened, so we're going to take that raise back. Probably wouldn't be good for anybody. That's why inflation has been sticky, hovering around that 3% range. And that's one of the Federal Reserve's target mandate, is to try to keep that lower. And if inflation keeps coming down, then that gives them the ammunition to lower interest rates. On the other hand, if it climbs, then the Federal Reserve now has the reason and almost the mandate to raise interest rates to combat inflation. So the question is, where's inflation going to go from here? It's been stuck in this range for a long time. But the last PPI report, it's the Producer Price Index report. It's the wholesale report it's the first report in line of how prices are reacting before it gets to you. And that report was very high. It came in at 0.7%. All that means to you is that the next couple of readings are going to be high. Inflation is going to go up. Who knows whether it's going to stay there, but that's what the report told us. And if inflation goes up, the Federal Reserve then is probably going to have to raise interest rates. Contrary to what we want, contrary to what they're saying, they're probably going to have to raise interest rates to combat inflation. That's one of their mandates, inflation, price control. The second mandate is the labor market. They want to make sure that people have jobs. They want to make sure that there's full employment. They want to make sure that the unemployment rate remains at a stable level. And the unemployment rate right now is sitting at 4.3%. And that's a very acceptable level. It's been in the low fours for a long time. It's ticked up a little bit, but that's not their concern. But the labor market is weakening. People are spending less money. That's because there are fewer jobs. It's harder to get jobs. And the reality is the consumer is starting to crack. The strength of the United States economy is all tied to the consumer. 70% of the United States economy growth, the economic growth in the U.S. is tied to consumer spending. Well, in order for consumers to spend, they have to have jobs. They have to feel good about spending. They have to have high wages. And we're starting to see that crack. There's a couple of indications of that. First of all, consumer savings has gone down, so it's giving them less to spend. And secondly, consumer debt has started to go up. So the consumer is softening. Now, if the consumer continues to soften, they quit spending money, that's going to have a trickle-down effect that ultimately leads to the stock market. If the consumer stops spending money, then in fact, it's going to mean that corporate revenues are going to go down. Revenues go down, profits go down, then the stock goes down. So it all trickles down, but it's all tied back to the consumer, and the strength of the consumer is based on the labor market, and that has weakened, and so has the consumer. So now all of a sudden, the Federal Reserve, looking at the job market or looking at the labor force, has a reason to lower interest rates. If unemployment starts to go up, the consumer starts to get weak, they want to lower interest rates. So here's what's interesting. They've got inflation, which is very sticky and maybe going to go up here. Looks like it's going to go up here a little bit. And that means that they would have to raise interest rates, the Federal Reserve. And they've got labor, which is weakening, which means they'd have to lower rates. What do? Do they raise? Do they lower? What do they do? Well, my best guess is that they follow the labor market more than the inflation market. It's more important to have workers working than it is to have prices under control. And there's still a balancing act. But if the labor market starts to crack, then in fact, I think that we may see them lower interest rates, even if that means a short-term tick up in inflation. So right now, I think the market is calling for one rate cut for the rest of the year. I think there could be one or two rate cuts. I also think that their best move right now is to do nothing. That there's no reason for them to do anything. Inflation is well under control. Even it's ticked up a little bit, and the labor market is still in good shape. No reason to do anything. So a quick update for you. Stagflation is something that could be right around the corner. Again, no growth with inflation. It's just something you need to be aware of and something that we're aware of on your end as we continue to manage your money. But let me bring that to point number 3. The first point, we talked a little bit about the referral event. The second point is I give you a quick market update. And now the third point is I want to just remind you briefly of something, how investing for income works. We've talked about this before. I talked about this, I believe, at our client appreciation event. I'm not sure. But I do know that I talked about what I'm going to talk about now in our last client webinar, which we did. We got a lot of questions about it. And so I just want to remind you of a couple of key points of how investing for income works. First of all, one of the questions that we've often got is, the market's up, how come my portfolio is not up? And the answer is simple. You're not invested in the market. You're not taking the risk of the market. That's the reason that you hired us. Now the market, had gone down recently about 10% at its low. Between February and April, market went down almost into correction territory. And guess what? Your portfolios didn't go down. Okay. And we don't know what's going to happen with the market. The market says, it's volatile. We got a lot of wars going on. It's very possible that at some point we have another recession. We don't see it right now on the horizon, but it's always possible when you're in the market. You're not participating in that. You're not participating in the ups. You're not participating in the downs. What you're doing is you're getting your 5 to 6% interest and dividends every single year. And your portfolio is going to fluctuate, but your 5 or 6% is going to come in every single year. Now, what you need to know is that, and what's happened is that your portfolios are very much tied to interest rates. So if interest rates go down, then your portfolio is generally going to tick up. And if interest rates go up, your portfolios are generally going to tick down. And some of you are aware of this. Now, regardless of whether you're taking income from your portfolio or whether you're reinvesting your income, I'm going to tell you that the fluctuation doesn't matter. If you're living off your interest and dividends, you're living off the eggs and you're leaving the chickens alone, it doesn't matter what the value of the chickens are. It doesn't matter what the value of your portfolio is. If you have $1 million in your portfolio and you're getting $50,000 a year, 5%, you're going to get your $50,000 a year regardless of whether your portfolio is at $1 million or whether it's at $900,000 or whether it's at $1.1 million. Your income doesn't fluctuate with the value of your portfolio. So if you're getting your income, then that temporary fluctuation doesn't matter. Okay, and mark that word temporary because we're going to come back to that. That temporary fluctuation doesn't matter. Now, if you're reinvesting your interest and dividends, I want to remind you of something we've talked about before, and that is this. It is actually beneficial for your portfolio to come down if you're reinvesting. Why? Because if the value of your portfolio comes down, now you're going to reinvest that $50,000 in our example at a reduced price, and you're going to get a discount. So when the portfolio bounces back, you're going to come out smelling like a rose because you kept investing and getting a discount on some of the investments that you already have. So whether you're living off your income or whether you're reinvesting, a market that is down, your portfolio that is down a little bit is actually doesn't hurt you when you're getting income, and it helps you when you are actually living off your interest and dividends. And I wanted to remind you of that because we do get questions every now and then that are comparing your portfolios to the stock market, and you can't do that. As a matter of fact, we had a question yesterday that was the opposite. Someone called us yesterday and said, hey, my portfolio's up a little bit this year, but the market's way down. Why? So it's kind of the opposite of, some of the questions that we get. But there's one more critical point that I want to discuss real quick, and that is the time frame, expectations. The market happens day by day. Within a month or so, the market went almost into correction territory. And within a few days, it came right out of correction territory. Year to date, the broad market is almost flat. I think it's down by about 0.5%. We've gone through a volatile cycle over that time, year to date. The market can happen very quickly. Fixed income portfolios happen very slowly. And we live in a microwave mentality. And the reality is that if you take the expectations of the market and you put it into a fixed income portfolio, that is a recipe for disappointment. Your portfolios are not designed to grow like the market. They're designed to protect your principal. They're designed to give you consistent interest and dividends. They're going to fluctuate. The market's going to fluctuate day by day. The market might go down in a month and 10% like it did, and it might come back in another month like it has. Your portfolio is probably not going to do that. Your portfolio is more of a slow and steady, wins the race type of thing. And what could happen in days and weeks and months with the market might actually take months and years to happen with your portfolio. The reality is it's much more conservative. You're going to see it fluctuate a lot less, but it's not tied to the market. And a lot of times the questions we get is, why is the market up and your portfolio is not? It's because you're not taking the risk of the market. Now, if you want to take some additional risk, you can. We have the ability to, put you in stocks. And if that's something that you've been thinking about, the market's done really well, and, maybe you feel like you're missing out, and maybe you feel like you can take a little more risk. I don't want you to make that decision on your own, but call us, talk to us, talk to Tuan. For those of you that know Tuan and love Tuan, he loves having this conversation. He's phenomenal at this. Feel free to call, talk to me. My door is always open, but the reality is we're certainly open to helping you make sure that you're invested the way that you should be based on your situation. So hopefully this video makes sense. If you have any questions, feel free to call Tuan or myself. Otherwise, the next video you'll get from me, hopefully in the next week or two, will be further information about this exciting referral event that we're going to have. Thank you. God bless.